Well, we're nicely diversified across the S&P 500 sectors. I don't know if we'll be as overweight as the more aggressive players will be, but we've been looking for the banks to perform better, and they certainly have this year. One of the best performing sectors for the S&P 500. But we'd be very careful. We're not traders. We're intermediate to longer term investors. And so we might not be as aggressive as if we were trading.
Do you think the interest rate environment, which, by the way, I mean, for all the talk of inflation, the bond market's done nothing for a month. In fact, if anything, yields have gone down. Is the interest rate environment favorable for certain equities and unfavorable for others, or can big tech just continue to roll?
Well, I think the problem for big tech has been that investors since last September have been diversifying into the value category. And so value is outperforming growth, and that's going to hit tech. But we can't help but think in this kind of environment with the last I looked, the 10-year Treasury was around 1.57% this morning. With that, at around that, we'd have to think that it's good for tech. Frankly, Brian, we're looking for tech and consumer discretionary to begin to perform much better after we get through the second quarter.
Much better. Why is that? Don't we buy the rumor, sell the actual sales?
Well, what we have to think here is you've got an economy that's improving. You've had materials, financials, real estate bid fairly heavily, and technology pretty much ignored this year. And we can't help but think the reality is technology is deeply embedded in the lives of both consumers as well as business. Of course, with that, as the reopening happens, everybody's on an upgrade cycle. Doesn't matter if you're a business or a consumer. We think we move ahead. We don't think technology has plateaued.
Yeah.
And just like it helped us in the crisis, it will help us coming out of the crisis.
If you bought stocks when things were worse, you made some money. We just had a guest on at the beginning of the show talking about the world. We talked about how France and Germany and Spain, they're on record highs. We don't talk about them much, but their markets are quietly soaring. They're probably 3 to 6 months behind us in terms of vaccinations. Some cases in Japan as well. Is it a better opportunity to buy stocks in Europe and Asia now than the U.S., given they're kind of behind us in where they are in the reopen?
You can't help but think so, Brian. We've been overweight the U.S. with meaningful exposure to developed and emerging markets internationally. The developed international markets happen to be very interesting because they are a lot of value plays, and a lot of the plays Japan and Europe are dedicated exporters. And as the rest of the world comes back, they're going to do a lot of business. So we continue to like Europe. We like small caps and large caps in the developed international markets at this time.
Shepard Smith here. Thanks for watching CNBC on YouTube.